because time is money, we will be starting the program right away so that we don't waste people's time that have joined us. This is the third of our webinar series for the Faculty of Plant and Equipment Professional Group of Nigerian Institution of Business Surveyors and Valuers. The idea of this is for us to listen, refresh our knowledge, listen to the current things happening in our profession, where it has to do with standards too, and equally use this as an opportunity for our upcoming colleagues in the future, the students of estate management, to listen to us and hear about our faculty and hear about what plant and equipment valuation is all about. I know that some of them, when they hear it, they get scared, but for them to know that there's nothing in it, that they say knowledge is power. Once they get the knowledge, they will be empowered as professionals. Now, for us to start, like I said, that when the president and the first vice and second vice join us, we will give them time to talk to us. It's going to be an interactive session. That's why we try to make everybody, but everybody should be on mute when you're not talking. When you have question, you can raise your hand. During question and answers too, you can drop your questions too in the chat box. The ones who see that is necessary, we can pick and get the panelists to attend to it. We are starting with our first presenter for today. That is in the person of ESV Samson Abato, PhD, who is a director in Moshood Abiola Polytechnic and is the principal partner of Samson Abato Consulting. He's a fellow of the Nigerian Institution of Business Surveyors and Valuers. He will be addressing us this afternoon as our first speaker today. IT, can you get ESB Samson Abato PhD to please come on and have your video on so that the presentation, the first presentation can start.
Good afternoon, noble colleagues. I hope you can hear me.
Sure, you're on.
Okay, thank you so much for the privilege to be here to present the paper, the faculty. Let me say a little protocol: the president in absentia, the first vice, second vice, council members, the distinguished fellows of the professions, my associate members, our distinguished students. It is a privilege for me to be here this afternoon to speak on a topic that is so important to the existence of our profession. That has to do with plant and machinery valuation, and to discuss extensively on the valuation approaches and those issues that arise in the course of our engagements. I'll be talking on this, and I have this understanding that we have gaps in the participants of today. We have students, we have associate below 10, we have associate above 10, we even have probationers. So we also have fellows. So in terms of our understanding and assimilation, I will try as much as possible to come to our level so that we'll have basic understanding, then we can take it off from there. It's expected to be like an interactive session, so we can ask questions from time to time where we need clarifications. I'm waiting for the IT to put my paper on. If not, then I will start my presentation, if I have the permission of the chairman of the faculty. So I want to thank the chairman of the faculty and every member of that faculty for the good job you are doing. You are making our profession relevant, especially at this time that we have stiff competitions in our existence. So basically, this paper will cover about 8 various areas: the introduction aspects, plant equipment valuation as an asset, then the purpose of valuation, the basis of valuation, the premise of value. And of course, I want us to look at factors to be considered in P&E valuation, then approaches to valuation, then we'll look at conclusion thereafter. Next slide, please. So in my introduction, I try to let us understand that plant and equipment, which we call plant, machinery, and equipment, is the same thing. Plant, machinery, and equipment is the same thing with plant and equipment. There are terms that are used for installation and support facilities for manufacturing in an industry, and they are meant to perform specific functions. So we have that at the back of our mind, and they can have combination of functions which enhance productivities. So they are operating facilities, and they can be movable. Of course, there are some that are fixed in nature, but they are different from real estate. We need to understand that, because real estate cannot, but they can be moved. They can be relocated from one location and to the other. So the valuation of P&E is a very complex process as it pertains to industry of wide spectrum, each having its own inherent characteristics. So when we are doing P&E valuation, we must understand that there are various industries, and within each industry, there are lines of production equipments that are specialized in nature. So they are specific, and we must bear that at the back of our mind. But what are the issues to be considered when we are doing P&E evaluation? Number one is the fact that specific utility or usefulness of the assets. As an asset surveyor and valuer, we are not concerned about the plant as if we are engineers. We are not. Our main focus is to understand the utility and the usefulness of the assets, so that we'll be able to ascribe value to them. Then we need to look at the contribution to the production of goods and services for which it was designed. Every plant is designed for a purpose. They are purpose built. And the moment they cannot perform that purpose, then they are failed utility tests and they might not have value. The other one is the fact that potential to produce and contribute to the profitability of the business. So that one is also important, so that they are not liability, but they constitute assets to the business concern or to the organization. Can I have the next slide, please? So when we talk about plant and equipment, we must understand that we as valuers, we have standards. And our standard develops from International Valuation Standard Committee that regulates the practice of valuation all over the world. And the objectives of that standard is to ensure that there's uniformity. It will ensure that valuers comply to those terms so that there won't be too much discrepancies. One of the challenges we have had nowadays is the issue of contention on the values arrived at by asset surveyor and valuer. And that has to do with the fact that some of us, we are not conforming with standards. We have international valuation standards. We also have our own local standard, the Green Book. So it is expected that we must conform with those standards. Some people are talking about audio. I don't know if my audio is loud enough. Mr. Chairman, sir, is my audio loud enough?
You are very clear. We can hear you loud and clear.
Yeah, I'm seeing some messages that they can't hear me well. Now, when we talk about plant, okay, when we talk about plant, it's an assemblage of assets that are strictly combined with others, and it may include specialized buildings, machinery, and of course, equipment. The combination of such assets is achieved by means of integrated support structures, the claddings and staging that are incapable of being separated from the assembly. So a plant is a complete package. It's different from a unit. A machine is an apparatus using or applying mechanical power, which is used for specific process in connection with operation of entity. Machinery may be individual machines or collections of machines. For equipment, we are talking about auxiliary assets that are used to assist in the operation of the entity or of the enterprise. Please, let's go, because of time. So when we look at the asset, example of plant and equipment, we talk about production plants, Coca-Cola, 7-Ups, those are plants. People that are making clothing, they are plants. Then we have service plants. We have air compressors, pumps, water reservoir tanks. We have petrol station equipment, firefighting equipment, forklift trucks. We have construction plants, we have effluent plants, we have motor vehicles, we have ocean moving vessels, and we have aircraft. So when we say plant and equipment as an asset, what are we saying? An asset is something that has the capacity of being owned. An asset is similar to a real estate. Okay, it has a life, it's determinable, it has useful life. And because of that, plant and equipment is an asset. So item of plant and equipment, which may sometimes be categorized as a type of personal property, are tangible assets that are usually held by an entity for use in manufacturing, production or supplies of goods or services. It can be for rental, maybe for lease, either financial lease, operating lease, and for others administrative purposes that are expected to be used over a period of time. So plant and equipment is an asset. And because it's an asset, we as valuers, it is our responsibility to determine the value. It is our functions to determine the value. But one thing I need to clear at this stage is the fact that as valuers, we have to work with professionals, which I'm going to discuss a little bit about. We work with accountants, we work with engineers. Okay, but we have different functions. So we need to work together in order to have the objective of the client. So the first thing in the valuation line for P&E is the purpose for which it is required. One of the standards is the IVS 101 that talks about the scope of valuation. And it says that it is the responsibility of the valuer to get in clarity what the client needs the report for. It's not about you speculating or you giving suggestion to the client. It is the responsibility of the valuer to ask the client, and it is also important that you get it done in writing so that whatever engagement you have is documented. So the purpose of valuation is critical to the work of the valuer. Where the purpose is not determined, there's no need for the valuer to do any assignment at all. I need to say that again. Where the purpose of evaluation is not established by the client, every effort of that valuer will be in futility, because every time you present a report, they will tell you that's not what they want. So it is very important that we get it clear at the beginning that what is the purpose of this engagement, because it is that purpose of the valuation that will lead the valuer to establish the appropriate basis for which that valuation will be done. And without understanding the basis of valuation, it will be very difficult for valuer to apply appropriate methods or approach for the valuation. So when we talk about purpose of plant and equipment valuation, number one is the fact that it can be for financial reporting. It can be for financial reporting. The essence of financial reporting is the issue of the finances of organizations, either in the public sectors or in the private sectors. For those ones in the public sectors, it is called International Financial Reporting Standards. Under that standard, there's what they call IFRS 14 that recognize the addition of property, plant, and equipment in the valuation. It is expected that the accountant, in inclusion of information into that accounting for that particular year, the value of the asset in terms of property, plant, and must be included. And in doing that, there are parameters for doing that. Okay? So the responsibility of the valuer to understand that standard in order to apply it in his approach to value. If you don't understand the standard, if you are doing valuation for financial reporting, you are just doing exercise without results. So for public sectors, they are known as International Public Accounting Standards. That is IPSA 17. It also recognizes the inclusion of the property and, of course, plant and equipment in the financial records. So we have situation where we have plant and equipment for leasing. It can be for lease. And when we talk about lease, lease can be in two forms. It can be financial lease, meaning that at the end of the day, the asset will become the asset of the company, of the business. But if it's for operating lease, it means that they will return it back at depending on their terms of engagement. So we must understand when P&E is for operating lease or is for financial lease. We must understand it at the point of inspection, so that we know what to include in our inventory and not what to include in our inventory. Of course, it can be for secure lending, where business entities, organizations, they want to take loans, and therefore they want to use their assets, which is the P&E, as a collateral. So you can use it for secure lending. It can be for disposal, okay, maybe for sales. And let me say here that the issue of plant and equipment can be for a going concern. A going concern means that it is part of the business. So it will continue to be used in the production of the goods and services. Or at times, it might be for alternative use basis, which means that they can sell it off to individual for alternative uses, different from what the business was using the plant and equipment for. Of course, it can be for taxation, determining what the company needs to pay to government in terms of taxes. There are times the issue of dispute arises in the running of business, maybe between partners, and there are litigations. So we know that such exercise might be required for litigation purpose, and it can also be required for insolvency, where business dies, okay, and where there's issue of liquidation as a result of mismanagement of the business. Definitely, there'll be insolvency, and of course, the asset will be required to be valued. So those are the basic purposes for which plant and equipment might be required. And those purposes must be established by the client. Please, I want us to understand that. So let's consider the basis now. It's when you understand the purpose, then basis becomes easier. It gives you direction. If for example, now an asset, the purpose is for disposal, you know that the basis to use is the market value. Because in market value, you are looking at transactions at an arm's length phenomenon between a willing buyer, a willing seller. There's no compulsion. There's available time for both parties to negotiate. That is market value. Okay, so we have what they call equitable value. Okay, equitable value comes in when partners are coming into a business and you want to know which each of them are bringing. Sometimes we call it like partnerships, sort of. So we also have what they call investment value, or the worth. When you talk about investment value, you are looking at value to the business or the value to the owner. It's different from market value. Okay. There are situations where the market value, investment value of a property might not really equate the market value because of a lot of factors. Then we have what they call synergistic value. That's marriage value. Parties coming together. The liquidation value, where an asset is to be sold with limited time. Okay, with limited time. And then the issue of market value will not arise because the party that is selling is not a willing party, but is selling because of the situation that happens to him. So it's a liquidation value. We have a fair value, which is prominent with financial reporting, because when you are reporting for financial reporting, it is not market value, you are reporting fair value. So anything that has to do with financial reporting, your basis of valuation must be fair value. Then we have what they call indemnity or the restatement value. In this situation, you are looking specifically for insurance purpose because of the issue of risk that are associated with usage of equipment. So, and in order to protect those investments, the owners of businesses want to insure them. But in insurance valuation, you need to ask your client, what basis of valuation do you want? Because you know that you need to pay premium to the insurance company. And based on the premium you are paying, will be subjected to what you'll be compensated in case of any loss. So for purpose of insurance, you must be able to separate indemnity from restatement. For indemnity, you are looking at the asset as it is in its present condition. So it's more or less like a productive value. And for the purpose of indemnity, you need to depreciate to reflect the status of that asset. But for restatement, you are looking for old for new. If anything happens to this property, what is the replacement for another one that will perform the same function? So at that level, you don't need to depreciate because the asset to be returned back as new. That's about a basis of plant and equipment valuation. But for all these bases, there is what is called premise of value. It is important for us to know that premise of value helps valuer in his judgment, appropriating specific instruction to the value. It's important that you understand the premise of value. A premise of value, or what we call assume use, describe the circumstances of how an asset or liability is used. Okay, different bases of value may require a particular premise of value or allow the consideration of multiple premises of value. Some common one has to do with highest and best use. We are used to that. We are used to that, especially when we are disposing an assets. Okay, as a gun concern, our objective is what will be the highest and best use for this particular plant. Now that we are not using as a going concern. Then the other one is the current use, or what we call the existing use. Is a premise of value that we need to look at critically. Then the orderly liquidation is that one is for insolvency, as I said, when there's a problem, like in the banking sector, when most of those banks went down, so they were liquidated. So they need to use that basis for the valuation. And then we have what they call the forced sale value. I know before now, a lot of us, we have thought that forced sale value is a basis of valuation. But international standard has taught us that it's not a basis, but a premise of value. Because you might not be able to determine in reality what is a forced sale. It has to do with the situation that that property is put in the market. It has to do with the location. There are a lot of factors that it's not about third of the value. That's a rule of thumb that we have been used to before now. It's a rule of the thumb. You realize that there are times that the market value of a property and the forced sale might even be equal, especially in places like VI, Ikoyi, Banana Island. So it is important for us to know that the premise of value will guide us in our basis of valuation. So can we move on quickly because of time? What are the factors to be considered in P&E valuation? A valuation of plant will normally require consideration of a range of factors which relate to the asset itself, the environment, the physical, the functional, and of course the economic potentials. Therefore, all plant and equipment valuers should normally inspect the subject assets to ascertain the condition of the plant and also to determine if the information provided to them is usable and related to the subject being valued. So here we can see clearly that inspection of assets is very critical to us as valuers. There are times that the client wants to send us the inventory of their assets. I want to say here that it is not professional for us to take that inventory and list it in our report and submit the valuation report. We are expected to see those assets because there are times that some assets are in situ. They are in situ because they are located where the inspection is carried out. But there are some assets that they are not within the location. They are not, they are outside. And they will tell you that that truck is in Warri as we speak, but it's going to move from Warri tonight to Sokoto. How do you know that that asset truly exists? So as valuer, we must exercise caution. We must exercise due diligence in ensuring that our inspection captures what is the reality. Because time and times again, we have realized that the inventory supplied to us does not match the actual of the assets that we see physically on site. So it is important for us to realize that those factors will hinder the outcome of our evaluation in terms of the opinion. So what are these factors? Let's go, please. What are these factors? We have what they call the asset-related factors. The asset-related factors. Number one, that is the asset technical specifications. We need to know that what is it? The remaining useful or what we call economy or effective life considers both the preventive and of course the predictive maintenance required for that plant. The asset condition, including maintenance history, we need to know. We need to demand for it. There are times they will say, don't worry. But these are the things that will affect our opinion at the end of the day. We must also understand any element of functional, physical, or technological obsolescence. Severally, when we talk about depreciation, our depreciation has been majorly on physical, which is the wear and tear. That's just an aspect of what can allow the value of property to go down. The element of functional, the element of technological, even economic obsolescence is critical. Then we must look at if the asset is not valued in its current location. If it's not valued in its current location, then what is the cost of decommissioning and removal? And any cost associated with the assets existing in place locations. That is about the installation, then you are going to recommission it, and of course, the optimal status to achieve. Next to that is for machinery and equipment that are used for rental purposes, the lease renewal options, and other end of lease possibilities. This is also similar to when we are valuing for real estate, and we have some leases that they are not renewable. So what are you valuing? Well, when the lease is renewable, you have windows to assume that that property will continue to be used for that purpose. So we need to understand it also for plant and equipment valuation. Then, any potential loss of a complementary asset, that is the operational life of a machine, may be curtailed by the length of lease on the building in which it is located. We need to look at that critically. Then additional cost associated with additional equipment, transport, installation, and commissioning. Then finally, for asset-related factors, we need to look at cases where the historical costs are not available for the machinery and equipment that may reside within a plant during a construction. The valuer may take reference from the engineering, procurement, construction contract. For environmental related factors, can we move up a little bit, please? Thank you, Mr. ICT. You are doing a great job for me. I appreciate that.
Dr. Abato, sorry, you have like 10 minutes to round up.
I'm in trouble. Then we have the environmental related factor. We have to do with locations, the impact of the environment, or other legislation that restricts utilization. Then we have the issue that has to do there with radioactive substance. Then the issue of toxic waste, which may be chemical in the form of a solid liquid.
Hello, sir.
So let's go on.
Hello?
Let's go on. Yes. Let's go on. So we have the economic related factors, which is the actual or potential profitability of the assets, the demand for the product, and of course, the potential for the asset to be put to valuable use. So let's move on again. Let's go. Let's go because of my time. The IT. So this is the essence of this paper, which is the approaches to plant and equipment valuation. I've laid the foundation. So there's a distinction between approaches and methods. Most of the time we have about 5 methods, 3 approaches. The difference is the fact that for approach, it has to do with to draw near, to advance near to a point aimed at to approximate a way of coming towards or reaching a person, place, or asset. For method, it is more specific. It's a way of doing anything, mode, procedure, process, regular, orderly, or definite procedures. Please, let's go. It's because I want to take students. That's why I came to this level. But let's go. There are 3 basic approaches to plant and equipment valuations, which can be transcribed to 5 methods of valuation. 3 approaches, 5 methods. So the first one has to do with the market approach. We are all used to this. And in market approach, you are looking at equipment that are homogeneous in nature. For example, you are valuing motor vehicles. Maybe it's Honda Civic, you know the model, or maybe it's Toyota Corolla, maybe it's the Hyundai. These are things that you can see in the market. And getting price for them is not difficult because you have what they call the second-hand use market is available aside from the manufacturer's market. So for this one, there's no problem. You have what they call direct comparison. Okay, you have what they call indirect comparison when you are trying to make adjustment for the usage of market approach. But the point here, which I want us to understand, is the fact that for market, there's evidence of similar properties being sold in the market. The market is available. Okay, so you can use what the market approach. But the only thing that differs is the fact that there are some specialized plants that you can highly find similar plant for. So in that situation, it might be difficult for you to use market approach. The other thing is that when you have a business that we call a going concern, of course, you can look at the performance of such a plant in terms of what is the market sales level. Then for the income approach, that has to do with the earning capacity. Income approach can only be used for a going concern, a production that will continue to be used for that particular purpose. So you look at the records in terms of their income potential or earning capacity. So is that you are going to capitalize on. The only challenge here is the fact that it is difficult for us to separate plant to know where is the performance of the plant compared to other assets that are used for production. So that's why it is a little bit difficult in plant and equipment for us to say we want to make records to income approach. It's difficult. How do you isolate building elements from the plant and equipment? How do you isolate the other components of asset like furniture and fittings. How do you isolate them for you to be able to know what value comes to the plant? That is about income, is about the earning capacity or the income potentials that arises as a result of the usage of the plant. The beauty of the income approach is that it enables you to know that whatever is the income being generated, the element of functional or economic obsolescence has been incorporated. Okay, it's already because of that obsolescence that is generating that nature of income. That's the only advantage with it, but it is a little bit difficult and complex for us to use for plant and equipment. Let me roll, please. The last one, the cost approach. Hello. The cost approach. For plant and equipment, a lot of us will make recourse to this. We make recourse to them because it is easier to use, especially when those plants, they are isolated and they perform different functions. So it's just for us to be able to get what is the cost of a replica, or what we call the restatement new. And we need to get a lot of costs that are associated with that particular plant for us to be able to ascertain that this is the value it goes. For the purpose of cost approach, the only thing I need to say, because my time has gone, is that we are not only making provision. Sorry, can we stop that noise at the background, please? For the purpose of cost, which I need to make clear, is the fact that we must differentiate between physical and other obsolescence. Because most of the time, our depreciation is physical. We just look at the assets, how many years has gone, maybe 5 years is gone, it has 5 years to go, and based on that physical wear and tear, we depreciate. With that, we normally overvalue the property. So there is need for us to bring the element of functional and, if possible, technological obsolescence into the assets. We have seen situations where an asset is bought 2 months ago, another one comes up today, the value of that one goes completely because there is no demand for it because of the impact of technology. So when we are using cost approach, we need to look at the models that are available. There are about 3 models that we can use for cost approach because of my time. The first one has to do with cost summation. If it's for disposal, what's the additional cost aside from the cost of disposals? You can look at what they call trending or price index. There are times that a plant, you can't see the price again. Okay, the manufacturer does not even have it, but you can trend the price to where it was coming from. At the time it was manufactured, how much was it sold? When was it? What is the exchange rate? What is the inflation rate? All this will come together in your analysis. And there's another one they call cost to capacity. You have an equipment, but the other one has different capacity, but it's different model. So you can be able to look at the cost to the capacity for you to arrive at what we can call the opinion of value. Let me conclude by saying that in Nigeria, valuation of plant and equipment must be prepared by estate surveyors and valuers, possessing the necessary qualifications, ability, and experience to execute a valuation in an objective, unbiased, ethical, and competent manner, and having the appropriate technical skills, experience, and knowledge of the subject of the valuation, the market in which it trades, and the purpose of the valuation. However, where a valuer does not possess all of the necessary technical skills, experience, and knowledge to perform all aspects of valuation, it is acceptable for the valuer to seek assistance from specialists in certain aspects of the overall assignment, providing this is disclosed in the scope of work and the valuation report. What this suggests to us is that it is not a crime that in the course of an evaluation, we have a valuer to support what we are doing. It doesn't make the engineer, it doesn't make the engineer to be a valuer. For example, when you do valuation for financial reporting, accountant will query everything you have done. They will ask questions on what you are doing because they want to know what you have done so that when they are putting in their records, they know what you have done it. But that does not make the accountant a valuer. So what is important is that every person understands their role and functions in the built environment so that there will be harmony in what we do. And on that note, I want to thank the faculty once again for giving me this window and the platform to present this paper. Ladies and gentlemen, thank you also once again. I will wait for questions so that we can respond accordingly. Thank you.
Thank you very much, sir.
Thank you. Thank you, our doctor. It is not it's a privilege to have a PhD present for us in our program that is even free of charge. You can imagine that we can't thank you enough, because if we all know the process you go through to get to that level. So whenever we call you, we'll thank you that you always answer us. You have been a great asset to the professional group and to the institution at large.
It's a privilege, my share. Thank you, sir.
Thank you so much. And I will, at this junction, I will we'll pause the presentation again and invite our president, the person of Chief Sir Okas.
No, yes, I'm enjoying the lecture. Let me listen to the next person before I give my speech.
Oh, fantastic! Thank you for that.
I'm enjoying it. I'm sorry, my noble colleagues, because I also want to learn. By the time I give my speech now, I might be tempted to leave the platform. So I want to listen to the next person so that I will also learn.
Fantastic! Thank you, my president.
Thank you. Thank you. I'm here with you.
We will now invite our next speaker. That's ESV David Marcelli.
Can I
Principal partner of the Lord Marcelli and Partners,
so that I can
of
share.
Our institution. Yeah, the IT will give you the. Okay, I think you're.
Okay, I'm already on. Yeah, okay.
You're already on. He'll be talking to us briefly for another 30-35 minutes on valuation principles. Thank you. Go ahead, sir.
Okay, thank you very much, ESV Ofili, Chief Ofili. Thank you, my national president, Chief ESV Wike. Thank you for my noble colleagues, especially the very, very young ones. I'm excited that many of the young ones are around. And I want to thank the plant and equipment business unit for arranging this free webinar. Knowledge is very powerful. Knowledge is critical. And the future of our profession depends on the ability of the younger ones to be able to appreciate the knowledge of the basic principles of valuation. As much as possible, I believe the concept of the organizer is that we should come as basic as possible. Very, very basic, so that we can understand the very basic principles of valuation. There's something that I've noticed, that in many aspects of valuation, even the ones we are not really involved in, some like valuation of gems, valuation antiques, valuation of franchise, it still boils down to the main three approaches to valuation, which is the cost, which is the market, the income, and the cost. So a very good understanding of the basic principles of valuation is important for you to be able to be dynamic and be able to flexible to go into other areas of specific aspect of our valuation. And that's why this meeting is important. This webinar is important. Okay, I just want to share a life principle. Observe people who are good at their work. Skilled workers are always in demand and admired. You don't take a backseat to anyone. If you want your service to be admired, if you don't want to resign and your boss is very excited, if you want to be seen everywhere and commonly seek after your organization, be good at your work. Skilled workers are always in demand and admired. You don't take a backseat to anyone. Proverbs 22-29. So our training objectives, I believe, for the webinar is to enable members to understand the basic of the principles of valuation for plant and equipment. And Dr. Agbatu has done a very good job for me, so I will avoid some of the things I've already planned to say. Is to grow competence, to improve skills, and to make you good at your work. To improve your skills, to make you good at the work. Concerning the background introduction of plant and equipment, ESV Agbatu has dealt technically on that, and I will just browse through that. What is plant and equipment is giving us also what has been listed here. I don't need to go through them again, what is plant and equipment. And let's just look at the valuation process. In the basic valuation process, first of all, is the purpose of valuation. It's critical in the valuation process as it determines further decisions to be taken, especially on the basis of valuation. Like he said, if you don't understand if you are not given the purpose, it's not even, you shouldn't even proceed with the valuation. That's what Dr. Agbato said. Because the basis of value will determine the methodology. The purpose determines the basis. The base determines the methodology or the approaches, and even the nature or character of data you need to acquire, sort for, even when you're on site or when you are out. So the purpose is the reason for which evaluation is being contemplated, or the intended use, which IVS 28 defines as the use of valuers' reported valuation or valuation review results as identified by the valuer based on communication with the client. Valuers must consider critically the relevant basis of value. Purpose and basis to be adopted has its root from your preliminary discussion with clients or intended user. So what we're saying here is that in your preliminary interface with the client or intended user, that's where the purpose is identified. You must need to get the purpose straight, and that forms part of your terms of reference or terms of engagement as contained in the standards, which one of our speakers will be talking about. So the valuer might be in a position to gather more relevant information on the purpose of the valuation and advise clients appropriately. There are times the client may not be able to really interpret or be able to define what he wants, but in the course of your discussion with the client, you are able to define the purpose for him and advise the client appropriately. Let me just share a story. Just about a week or so ago, one of the multinational companies, organizations in this country, they called me that they wanted to do, one of them called me, wanted them to do an insurance valuation for the assets, and it was so urgent. And he sent me the terms of reference, and I went through it. I only saw IPSAS, IFRS, financial reporting. So I called him. I said, this does not tally with your purpose. And it was in the course of the discussion he understood that maybe he sent me something different, and they had to go back and rethink what they wanted. So in our discussion with our clients or the intended user, a lot of information needs to be distilled from them, and it will help you clarify the purpose appropriately. And by our terms of engagement in our green book, when it is in writing, it is very clear what the purpose of valuation is about, and you can advise clients appropriately. Now, let's just look at a blueprint or the principle of valuation platform equipment, talking about purpose, basis, and methodology. You have the purpose. We've dealt on the purpose. Dr. Agbato mentioned them. You see some of them: sales, mortgage, insurance, financial reporting, companies, mergers and acquisition, privatization, probate, and others. Now that leaves you with an arrow to the bidder. It helps you to determine, after knowing the purpose, it helps you to determine the basis to use. You have market value, you have fair value, you have insurance value, you have liquidation value, you have market rent, you have others. There are many others that are not listed there. Then basically it takes you now on the right arrow to methodology. So you have known the basis. Okay, what methodology or approach do you adopt? You have the direct sales comparison, you have the income capitalization method, you have the depreciation replacement cost, you have the replacement cost or reinstatement cost, and you have the discounted cash flow also. So these are, so you can see the flow. You know the purpose is important. Purpose determines the basis. The base determines the methodology. You can't go, somebody calls you and says his purpose is for insurance, and you already determine the basis of valuation, which is insurance value, and you also determine the method, which is reinstatement or indemnity, as said by indemnity. So we need as valuers to understand the flow chart between purpose, basis, methodology, and methodology. There's also another part. It also helps you to even determine also the kind of information you will need in in terms of valuation analysis and the arrival of your value of opinion. Now let's look at purpose of the valuation. We talked about mortgage or loan purposes, financial reporting, sales purposes, insurance, privatization, mergers and acquisition, compensation, and acquisition. Don't mind it, we've listed this before, especially when Dr. Agbato spoke, and also I've also raised it before in my chat. So that's why it appears as if I'm speaking so fast. Probate, then the base of value, IVS 2020, well, IVS 2022, please, which went into operation on the 31st of January 2022, defines it as the fundamental premises on which the reported values are or will be based. In some other clients, it's called the standard of value. So we have the base of market value, we have fair value, we have equitable value, we have investment value, and we have the synergistic value. I will spend time first on the definition and explanation of each basis of value in my talk. And we look at the market value. IVS 2022 defines market value as the estimated amount for which an asset or liability should exchange on the valuation date between a willing buyer and a willing seller in an arm's length transaction after proper marketing and where the parties have each acted knowledgeably, prudently, and without compulsion. Now let's look at some of the critical issues and components of that definition. Then we'll take them one after the other. 1A said the estimated amount. This refers to a price expressed in terms of money payable for the asset in an arm's length market transaction. It's an estimated amount, which refers to a price expressed in terms of money payable for the asset in an arm's length market transaction. Then it talks of an asset or liability should exchange. Refers to the fact that the value of an asset or liability is an estimated amount. It is not a predetermined amount. It's not an actual sale price. It's an estimated amount rather than a predetermined amount or actual sale price. It is the price in the transaction that meets all the elements of the market definition at the valuation date. So what it means you can have, that's where the issue of special purchaser is in your analysis. You have a special purchaser that will not fall
I think his network is having issues. Might probably need to sign out and then come in again.
It seems the Mr. Marcelli's network is having glitches now. While we wait for him to come back.
Yeah, I can. While we wait for him to
President,
come back,
would you-
yeah, I can give my address. Okay.
Thank you. Thank you. Go ahead, my president.
Okay.
Now go
Okay. Yeah, I can go ahead and give my address. Hello,
Mr.
Kevin.
Marcelli, are you back? Go ahead, my president.
No, if he's back, okay, you are back. Okay, Marcella,
Are you back?
Let me step aside
Okay,
for you.
go ahead.
You are doing a very important work.
Yeah.
Okay,
Thank you, my president.
You're welcome.
Noble colleagues, I'm very sorry for the thing just went off. Okay, talking about between a willing buyer refers to one who is motivated but not compelled to buy. The buyer is neither over eager nor determined to buy at any price. This buyer is also one who purchases in accordance to the realities of the current market. This definition provides a foundation for your valuation analysis of comparables. So when you are dealing with comparables, you get close comparables which falls within a willing buyer. Now, a willing seller is neither an overeager or a forced seller prepared to sell at any price, nor one prepared to hold out for a price not considered reasonable in the current market. Then in an arm's length transaction is one between parties who do not have a particular or special relationship, e.g. parent and subsidiary companies or landlord and tenant, that may make the price level on characteristics of the market or inflated. The market value transaction is presumed to be between unrelated parties. It's like me trying to sell one of my flats to a well-loved in-law. Definitely, it will not be an arm's length transaction, and it will not be relevant for comparables. Such comparable, if it's the only one you have, must be adjusted to other information. After proper marketing means that the asset has been exposed to the market in the most appropriate manner to effect its disposal at the best price reasonable in accordance with the market value definition. Then just where the parties have acted knowledgeably, prudently, and presumes that both the willing buyer and the willing seller are reasonably informed about the nature and characteristics of the asset. Buyers and sellers who really don't know what the market is all about, what has happened recently, the market has gone high and that, you understand, their acceptance of the value, the price, may not be very critical in the definition of market value. Now, we now go to fair value, our second definition of the basis of value. There are different definitions. The Organization for Economic Cooperation and Development, OECD, defines fair market value as the price a willing buyer will pay a willing seller in a transaction on the open market. For United States Tax Purposes Regulation 2020-31 states, the fair market value is the price at which the property will change hands between a willing buyer and a willing seller, neither be under any compulsion to buy or to sell, and both having reasonable knowledge of relevant facts. Fair value, International Financial Reporting Standard, IFRS 13, which also the IVS accepts, which is the definition of fair value, as the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. If you look closely at all the definitions, they look the same, you understand, and it's also the same. They look like market value. It talks about being exposed to the market, willing buyer and willing seller. It talks about the property being orderly transaction. But if we go further into fair value and market value, you know there's a difference as over time be established. But let's look at fair value and financial reporting. And I want to just say that it's been established, it's been stated by Dr. Agbato, considering that it is now mandatory for all public business entities and institutions to adopt the International Financial Reporting Standard, IFRS, the base of the valuation will be the fair value as recommended by the IPSAS and IFRS and the International Valuation Standard Committee. Market value is no longer a basis for companies' account or any financial reporting. Let me just share this quickly. I had a discussion with a younger colleague. I'm older than him in the profession, and he was reporting a matter about a colleague who is also my senior, so you could see the afar apart. He was asked by to provide valuation for financial reporting, and after he did the valuation, he sent his report to be reviewed by this senior estate of you, and both of them had a shouting fight concerning market value and fair value. The senior colleague insisted it must be market value, while he was insisting that it must be fair value. At the end, they came to a compromise. I can't remember what the compromise was. So I'm advising every one of us, the very senior colleagues, the younger ones, please let's have a knowledge of what is currently happening let's educate ourselves. Let's take time to learn every day so that we don't get into a situation where, as a senior person, a surveyor, I'm speaking to a younger one and trying to establish my position based on my age or my distance on something that is not factual and something that is not relevant. So for financial reporting, market value is no longer a base for value or for companies that account for any financial report. But if a company calls you to value an asset for them for sale, then you use market value. But if it's for financial reporting, you understand, in financial reporting, it must be fair value. Also, there are also situations where values are carried on the basis of fair value, and the companies, they want to sell the asset and they begin to insist that it has been valued. It's not correct. It was valued based on fair value, but now they want to sell the asset. It must be valued on the basis of market value because they are different. Now, what's the difference between fair value and market value? I'll run to that. They are not the same. Market value takes into consideration the price, and hypothetically buyer and seller will agree on the property without acting under no compulsion and having good knowledge of the market on a particular date. The market dictates for market value is critical. It's market dictates demand and supply. Fair value considers, but for fair value considers what a willing buyer and seller are willing to agree amongst themselves. Each acting under no undue influence, though they are knowledgeable of the market, but the property or asset subject to valuation is the fundamental issue in the transaction, but not influenced by the general market. That means demand and supply consideration in terms of fair value is minimal compared to market value. Fair value recognizes the participation of a special purchaser, but it must be advantageous to both parties. Like, for instance, there's a company's property which is adjacent to another property, and they are about to buy it because it will help them to marry synergistic value. And at the end, there's a price which is higher than the other one, the normal transaction where the buyer and the seller are not connected. And that means the fair value provides an adjustment, being a special purchaser, and it becomes advantageous to both parties. Fair value considers predominantly the fundamentals of the property in question, e.g., synergistic market value, like I have said, future growth and risk factors, while market value considers only the demand and supply influences only. Fair value is intrinsic in nature. That means the property itself is critical for fair value valuation. And that is why discounted cash flow method is essentially attractive for fair value when you are determining fair value opinion. That's why some companies will ask for this discounted cash flow method, because it's intrinsic in nature. The market value fluctuates more than fair value. These are just some of the differences between market value and fair value. So we go to equitable value. Defines equity. IVS 51 defines equity value as the estimated price for the transfer of an asset or liability between identified, knowledgeable, and willing parties that reflects the respective interests of those parties. Equitable value requires the assessment of the price that is fair between two specific identified parties, considering the respective advantage or disadvantage that each will gain from the transaction. It is different from market value. Market value more or less determines the interests of the entire market, while equitable value talks about two parties, their specific interests, and considering their respective advantage and disadvantage that each will gain from the transaction. Then investment value. Investment value. Investment value is the value of an asset to a particular owner or prospective owner for individual investment or operational objectives. Market value is objective. Investment value is entity or specific, is an entity-specific basis of value. It is not objective. Investment value focuses more on specific persons or entities, investment requirements, knowledge, and strategy. The basis of investment value reflects the benefits received by an entity from holding the asset and therefore does not involve a presumed exchange. There's really no, it does not take into consideration an exchange, a market exchange. It only reflects the benefit of the holding organization or the owner to himself. Therefore, it is not market-based, it's not a market value. So the many are times where some of your clients may want to force you into providing an investment value for them instead of market value. When you know clearly the purpose is for market value, you need to stand your ground and tell him, except he's asking for an investment value and not a market value. This is also called the worth of an asset. Then liquidation value. IVS 2013 defines liquidation value, the amount that will be realized when an asset or group of assets are sold on a piecemeal basis. Liquidation value should not take into account the cost of getting the assets into sellable condition. Should take into account the cost of getting the assets into sellable condition as well as those of the disposal activity. Liquidation value can be determined by under two different premises of value, as stated before: orderly transaction within a typical marketing period, or a forced transaction within a shortened marketing period. In the sale of Nitel, I think in the 90s, no, it's not in the early 2000, they did an orderly liquidation, orderly transaction where assets were grouped and they took time to identify them, you know what I mean, and divided them between the one that could be sold individually, the one that can be sold in lots, the one that can be sold to communication companies. But a forced liquidation is where an auction sale and things are just striped and sold as individual lots. Now, synergistic value. My chairman, please, Mr. Philip, you help me with timing, please.
You just have 10 minutes.
Okay. Synergistic value, the result of a combination of two or more assets or interests, where the combined value is more than the sum of the separate values. This one talks of a marriage value, where the two different assets when they are merged, the value appears higher than when they are valued individually. So in a situation where if the synergies are available to one specific buyer, then synergistic value will differ from market value, as the synergistic value reflects particular attributes of an asset that are only of value to a specific purchaser. The added value and the added interest is often referred to as marriage value. For sale value, I just want to take my time, though Agbata has spoken concerning the term for sale is often used in circumstances where a seller is under compulsion to sell, and that as a consequence, a proper marketing period is not possible, and buyers may not be able to undertake adequate due diligence. The price that will be obtained in these circumstances will depend upon the nature of the pressure on the seller and the reasons why proper marketing cannot be undertaken. The price obtainable in a forced sale cannot be realistically estimated. The price that the seller will accept in the forced sale will only reflect its particular circumstances rather than those of the hypothetical willing seller in the market value situation. And that's the challenge many of us have with banks. You are asked to give a forced sale value in 2022 and they want to sell in 2024. And in 2024, a lot of things may have happened, things may have changed, and they want to use your forced sale value as a determinant for fixing their prices. And when it doesn't work, they come to us and say there's something wrong with our valuation. So that's the challenge, because you cannot realistically estimate a forced sale value for a future circumstance, future circumstances. It's not possible except we want to become voodoo valuers. So a forced sale is a description of the situation under the exchange take place, and it's not a distinct basis of value. It's a premise of value, premise of the sale. So I want to advise every of our valuers, when we are asked by banks, please qualify your valuation. Qualify it, state that it's not a base of value, but for their purpose, that this is within a period of certain period, that's when your forced sale value will be recognized for you to be able to the market rent is the rent, the estimated amount for which an interest in a real property should be leased on the valuation date between the willing lessor and the willing lessee. on appropriate lease terms in an arm's length transaction, often proper marketing, and where the parties have acted knowledgeably, prudent, and without compulsion. The conceptual framework supporting the definition of market value should also be applied to assist in the interpretation of market rent. Just the framework for your market value should also be the framework for your market rent. Then we talk about insurance. That is a basis. There are two bases on which the fixed assets can be insured: indemnity, restatement. And indemnity requires that the insured shall be left after settlement of the loss in as nearly as practicable the same position as if the loss had not occurred. If the asset or property is to be repaired, the measure of indemnity will be the cost of repairs, less negotiated allowance for pre-fire depreciation or the betterment where the repairs result in a better asset than existed before the damage. If the asset is not to be report, the measure of indemnity could be the reduction in the market value from the damage provided. This does not exceed the cost of repairs less depreciation. So technically, principle of indemnity puts the person back in the position where it was. It is not new, and technically it's market value, you understand, adjusted to the condition it was before the damage took place. That's the piece of indemnity. The restatement means is cost for new. You understand? And most organizations in Nigeria, they insure based on new. They are not, a bank is not expected to go and buy some new old items when there's a fire mishap or so. So generally, as a rule, most organizations, their shop is based on estimate cost for plant and future plan. So it's important for you to discuss with your client. You understand, to know their insurance policy, is it restatement, is it indemnity, and advise them accordingly. So the valuation approach and methods for plant and equipment, first speaker has dealt very well on it. I will go into that. The market approach, income method, cost approach, cost approach. These are the three basic ones. And finally, I want to just do a cap of what we have said. And if this is what you can take out of the presentation today, I'll be very happy. It talks about purpose of valuation. One, let's take this as an example. Financial reporting to include in company's account. What is the basis? Fair value. What is the methodology? Direct comparison, market, investment method, income, depreciation, cost. Sales, privatization measures. What is the basis? Market value. What is the methodology? Comparison, investment method, depreciation, replacement cost method. Mortgage, secure lending, bank loans. What is market value? For sale to be qualified, as I said. Direct comparison method, investment method, depreciation replacement cost method. I want to say something concerning bank loans. When you talk about a bank loan, it is obvious your mind should go to a situation where there'll be a foreclosure. The worst situation is that the property will be sold in the market at a certain time. Now, if it is sold in the market, what will be realized? So you need to be careful that it will be dictated essentially by the market. You can't be valued a motor vehicle where for a Toyota Corolla, maybe 2006 model, where there's an active market for maybe sales of about 1.8 million, and what you are valuing is something quite older than that, and you need to depreciate, because that's market comparison. Now, usually in market comparison, to discount. Now, you want to use a cost method where current Toyota Corolla is about 40 million. And even if you apply 80% discount, there's a tendency that your final figure might be out of the way. So we must be careful that for mortgage loans valuation, market value should be critical. Comparison should be important. We must have that comparison. And offers in the market are not comparison. It is actual sale that is the real comparison. Offers are not comparison. If for instance, you don't have a direct comparison of an actual sale and you want to use offers, then you need to qualify it, you need to discount it, and you need to adjust it. The insurance, you have indemnity, you also have replacement. And if it's indemnity, you are using direct comparison market. If it's replacement, restatement, you are using replacement with production cost. Compensation and composite acquisition, land, pipeline, you are using restatement of them. These are statutory, Land Use Act. Then others, probate, capital gain tax, land use charge, tenant rate, all of those are statutory basis. So this figure gives you a summary and a narrative of the flow between purpose of valuation, basis of valuation, methodology of valuation. Please, my wonderful colleagues, the young ones, please, this summary is important. You need to know the basis, the purpose. It takes you to the basis, and you have to know the methodology of valuation to be adopted. This is not exhaustive, but it just gives a blueprint for our understanding. I want to say thank you for my talk. Thank you for everyone for allowing me to speak. Thank you for the faculty for the business unit of plant and equipment for allowing me to speak. But please permit me, I want to just share something. Last year, I was diagnosed of cancer. I was supposed to die. And next week, I'll be speaking in a place, sharing my story. If you're interested in watching it, I want you to join them at Rema Nigeria Live. David Marcelli's testimony, 21st to 25th March 2022, 12 noon to 1 p.m. You can watch on Facebook, Rema Nigeria Live. I think it will challenge you, and I think it will give you hope, and those of your friends also. Thank you very much. God bless you.
Thank you. Thank you, Mr. Marcelli. Well, we are not surprised because we know the quality of people we have in our profession when it comes to things to do with valuation. And our joy is that whenever we call, they always answer us. And we'll call you, you answered us. What you just shared for us on the talk you want to give us sometime, is it next week you said on your experience with cancer? Maybe you will probably let us have it later. We can help you broadcast it. But we all need
it's next
wealth.
week.
They said anybody that needs wealth should listen to what you want to share next week. Okay, later you let me have the flyer proper so that we can share it proper for. Thank you so much. May I call on our president now to give us his speech? To hear from our president.
Is our president thank you very much. Yeah, thank you very much, noble colleagues. Good afternoon. Well, first of all, let me, on behalf of the National Council of the Nigerian Institute of Estate Surveyors and Valuers, thank the facilitators, Dr. Samson Abato and Mr. David Marcelle. And while we are waiting for Ademola to also give his own paper, I want to thank you for accepting to talk in this webinar-based training program on fundamentals of plant and machinery valuation as it relates to our field practice. Having listened to the two speakers, you find out that they have gone as much as possible to tell us much about the fundamentals. These are the things that we need to know as estate surveyors and valuers. And if you want to actually be a specialist in plant and machinery valuation, it means that you would have learned a lot from these two persons. And I am without prejudice to what Ademola will also give to us. I think these are selected people who have knowledge, who have experience, and who have been members of this business group for a very long time. So I'm happy that the chairman and the secretary found them worthy to actually come and share their experience. As a professional body, NAIS places very high premium on its members' skills and capacity building. This is the only way to remain relevant and also to benefit from the potentials and long-term prospects in the industry. I am glad to note that the quality of service rendered by our members to our esteemed clients and organization has greatly improved as a result of continuous training and retraining during this our administration. I wonder if there is any month or any 2 months that you will not see either a branch or a business group that is organizing one training or the other. It's either a webinar or a physical training, And most times you find out that some of all these things are beneficial and things that we need as professionals to build our skills and to also to improve on the quality of service that we render to our clients. So I'm happy that our people are beginning to learn and not just to look at it that it's only either for the young ones or for those that are coming up. Even with the elderly one in the profession, we need to know some of the changes that are happening within the profession. We shall keep growing our standards and professionalism via training and retraining in order to be at par with international best practices and standards, especially in today's technology-driven world. We cannot afford to operate in isolation of other internationally accepted market standards in the real estate sector. Already the world is a global village. So it is not possible now for us to say because we are in Nigeria, we don't want to know what is happening in other countries. No, that is not good. We need to know what is happening around us so long as real estate valuation is concerned, so long as asset surveying and valuation is concerned. We need to begin to have a cross-examination. We need to have cross ideas so that people will begin to also build up their capacities. We should also let our contemporaries know what is also happening in our own country so that let it not be as we are not doing anything in our own climate. I would like to congratulate the chairman and the secretary of the Plant and Equipment Valuation Business Group, who happens to be Kovinofili and Adimola. I want to thank you very much because you have been very active. One of the most active business group we have is Plant and Equipment Group, right from when, even when David Masele was the chairman, to when Sansinabatu, then Asato, now to Kevin. You've been very active, and I pray that God will continue to give us leaders that will be ready to make sacrifices to put our faculty, our business groups in a position that will be for them to be the full soldiers for the institution. I must also congratulate all estate surveyors and valuers and other professionals who embraces this initiative. If we must stay ahead of the curve and keep progressing in our professional endeavor, we must continually and consistently update our knowledge, skills, and competencies. The Nigerian economy is unique in various ways, with specific challenges in all areas of professional services. Fundamentals of plant and equipment valuation as it relates to field practice is one of the specific challenges. It is my hope that this training program that we have already started, that at the end will be more informed, more educated, and also be ready to learn more of the current and recent happenings within the industry. So on behalf of the National Council, I want to thank all of us who are participating. I want to also thank those who have set up time, in order to prepare their papers they have presented this afternoon. So I want to thank all of you, and I wish you a happy deliberation. Thank you, and God bless you all.
Thank you,
my president. Thank you, my president, for your time. We appreciate you so much because we know how we disturb you from different professional groups, different committees. Everybody wants your attention, and you have gladly made yourself available for the institution. God will continue to strengthen you for us. Thank you, my president. Thank you. We now, without wasting time, call on ESB Ademola Ladiga to come up for his presentation. Ademola Ladiga is the secretary of the professional group and is the principal partner of AOL Consult. He's an associate of our institution. Ademola, please.
Thank you very much, my chairman. Good afternoon, noble colleagues, and good afternoon to everyone who has joined us this afternoon. And standing on the existing protocols, I'm really a bit nervous because I'm speaking now after all my seniors. As seniors in the profession, I've actually spoken, starting with Dr. Agbato and then ESV David Maseli, and thereafter, the speech by the president. One thing is this: I can recall the essence of we having this program for the upcoming valuers and also the valuers who are practicing already is the first vice challenged us when we came on board sometime in year 2020 regarding how we need to carry along the students. Luckily for us now, we have over 300 participants active now, out of about over 1,000 people who registered and intended to join for this program, So over 300, which is really a record for the institution for us to organize a program like this, and then over 300 people. And we also took advantage of the fact that the students are at home now because of the ASU strike, which is an unfortunate thing on its own. So in view of this, we decided on our own, let us carry them. As the chairman earlier said, people here, plant and machinery, a lot of people want to run away from it and like, oh, this is too hard. I don't want to go to this field. Plant and equipment is difficult. Yes, it is difficult because it's specialized discipline in the aspect of the valuation profession. However, the aim for us is to go down as much as possible to the students while they are still in school, receiving the academic knowledge. Then we also are giving them the practical field knowledge as well. This is the essence of we having this program. I'm going to be speaking on the International Valuation Standards 2022, which became effective on the 31st of January this year. Much of the things that have been spoken about, I'll just touch on some of the things that have been spoken about by Dr. Agbato and also Dr. ESV David Maselli. So we'll be going into the presentation. Now, this presentation is going to be divided into 3 aspects. Next slide, 30 minutes thereabout. I should be concluding like around 3:15 p.m. I should round up. So the presentation is going to be in 3 parts. The first aspect will be to introduce the program or introduce the topic. The second aspect, some of the changes that were made and the arrangement of the valuations. And then the last aspect of our discussion will be the implications of not following the valuation standard. Now, there's a program that was held in November 2021 as a prelude to the International Valuation Conference that is coming up later this year in Saudi Arabia, Riyadh in Saudi Arabia. The conference holds biannually. The 12th edition ought to have taken place in Saudi Arabia sometime in the last year, 2021, but unfortunately because of the pandemic, it was moved forward to this year. Then one of the directors that work with the Saudi arm of the like evaluation organization in Saudi, as we have Nigerian Institution of Ethics, Surveyors and Valuers in Nigeria, the Saudi arm is Mr. Paco Wilfield, and I'll take a quote from what he said. He said, during the program, the IVS and the International Financial Reporting Standards matter. They are created for a reason to guide valuers in proper conduct and to foster stakeholders' trust in valuation process. While we are in school, some years back, because I left school almost 20 years ago, and then there are certain aspects of valuations that we are taught in school, but not necessarily the valuation standard. We are taught the definition of estate management, principles of valuation, methods of valuation, but none while we were in school. The valuation standard is an aspect that was not, that we were not taught. Maybe in the new curriculum now, the NBT, the National Board for Both Technical Education, and then the National Universities Commission, maybe they would introduce going forward. But the valuation standards, so for the students who are among us now, participating, some of the things they would be taken back to school when the strike is called off is an aspect that, in the training that I participated in, we were taught about international valuation standard. Now, this standard are like the Bible, the manual for every valuation that we do. Please take note of this. The international valuation standard is like the bedrock, the foundation that all the things Dr. Agbato has spoken about, and also ESV David Maselli, are fundamental things that are taken from the international valuation standard. So all the methods are there, the things that valuers need to know. Going back to the introduction that was given in the last conference, who are the stakeholders? The stakeholders are the valuation users, the bank, the individual that wants to buy a property, the individual that wants to take a decision based on your own valuation. So the idea of we doing a valuation and that valuation conforming to standard is to ensure that the stakeholders have confidence in what we are doing. And I will give you an example. For instance, now, if a property is in Ghana, Ghana is very close to us. I'm using Ghana as a reference. You have a property in Ghana, and someone in Nigeria is interested in investing. The same way, what we can see from all the diversifications that we are seeing, Guinness, Toyota, Dangote, Dunlop. There was a time Dunlop actually relocated, left Nigeria some years ago and went to Ghana. So if Dunlop intended then to acquire a property in Ghana, for instance, and then a valuer in Ghana was invited to do the valuation, and then the valuation report was sent down to Nigeria to Dunlop for the stakeholders at Dunlop to take a decision regarding the valuation. Now, if the valuer that has done the job in Ghana actually followed the principles, the guideline, and the laid down rules in the national valuation, believe you me, there will be no reason for another valuer to go to Ghana from Nigeria to verify what the valuer has done. Let me interchange now. What I'm saying is that for those of us who are practicing in Nigeria, and then the students who are among us intending to become professionals in the next 2, 3, or 4 years that will be graduating from schools at that time. Now, someone is interested in coming to Nigeria the same way, maybe Twitter, for instance. Let me give an example. It's something that is familiar, the ongoing discussion. Twitter is coming. Twitter wants to establish in Nigeria, and they want to buy a property in Ikoyi. Twitter has invited any one of us, maybe Paul Osaji, Jide Taiwo, any of the firm, and said, okay, do a valuation for us on the property in Ikoyi that we intend to acquire. We want to acquire this property. A firm has been selected in Nigeria to do this valuation. The firm has done the valuation, and the report is sent by email to the headquarters of maybe Twitter in America. Now, those people who are using the valuation to take a decision so that they would come to Nigeria to invest, if that valuation has been done in line with the international valuation standard, then Twitter would not bring a John White from America to Nigeria to come and do another valuation. That is all the standard is saying. That is the aim of the standard, that let us unify that when a valuer is working in Nigeria and he follows the standard, you don't need, because a couple of years back, we have that challenge that some companies actually bring in foreign valuers into Nigeria because of that lack of confidence. Many years ago that we had to fight and all, and it's even still happening up to now that sometimes engineers and some other people want to encroach into the work of valuers. But international valuation standards, the committee are looking at how to increase the confidence that a Zenith Bank would have and say, okay, an estate surveyor and valuer, you can do this valuation, provided that you are following the international valuation standard 2022. So we can, so some of the aims of the committee is that let us unify the standard that if you are doing a valuation here, it is acceptable, then there will not be any need to bring in foreign valuers. Going further in our discourse, the next slide now, it says another justification to keep learning about this standard is that knowledge keeps evolving. A lot of us would agree. We are in the past now, probably would have put ourselves in a room, maybe in one hall. A lot of people called me before this program happened today. They were like, oh, where is the venue? Where is the hall? Is it in Lagos? Is it in Abuja? Now, one of the things that we need to take advantage of is technological involvement. Those are some of the things that the International Valuation Standards Committee, IVSC, found and then keep evolving. So what I'm saying in essence is that we had International Valuation Standard 2011, we had 2013, we had 2015, we had 2017, we had 2020. Now we are in the era of the International Valuation Standard 2022. Now, we are going to keep talking about these standards all the time. Another valuation standard will be coming out in the year 2024. That's a year after Nigeria's election. Some of these things that are presently not inside the IVS 2022 now would be inculcated in the one that is coming thereafter. So the essence was trying to justify why do we need to talk about these standards? Why not just valuation principles? Why not just, so this standard, as we said earlier, is to give the stakeholders. So if you have followed the standard, the bank or the beneficiary of the report would be happy that, okay, well, whether I'm in Ghana, whether I'm in Australia, whether I'm in Switzerland, provided the valuer that has done this thing has followed the standard, that's all. So For us now, some of the things that we are taking away from this seminar or this program is that standards do matter. While I am learning in the school, while I am learning in participating in programs, I also need to learn more about the international valuation standard. So a couple of years, another standard will come. We will have to organize some training as well to teach people and also to educate on the importance of this valuation standard. Next slide, please. Let's now go into the second aspect, which is the valuation standard. As I said here, maybe in a couple of months' time, we're going to be doing another seminar that will probably be focusing on the International Valuation Standard 2022 because they have asset standards. As I listed here, I said the valuation standard teaches on valuation purpose, the basis of valuation, as well as the approaches or methods of valuation, as already highlighted by my senior colleagues in their presentation. Now, let us talk about some of the changes, some of the things that we are expecting in the International Valuation Standard. The first one here that I have, which is the top bullet, it said, the latest edition of the International Valuation Standard marks an important milestone towards harmonizing valuation practice worldwide. I have talked about this earlier. What they are saying is that a valuation that you as a Nigerian valuer has done, and that report is sent to President Joe Biden in America, or is sent to the Canadian Prime Minister, or is sent to Vladimir Putin in Russia. Vladimir Putin in Russia, or any of the international leaders, or any of the heads of this organization, they don't need to send another valuer to Nigeria if you have followed the standard. So the aim of IVS 2022, which I'm repeating now, is that they want to uniform valuation practice worldwide. So in order for your valuation report to meet international standard, you must follow the IVS. The IVS can be downloaded after this program, or maybe later. You can download the International Valuation Standard 2022 online for you to read, and then read them before you go into your valuation assignment. Now, the other aspect, it says IVS serve as a key guide for valuation professionals globally and will underpin consistency, which is what I already talked about. That, okay, if I'm using income method, we have talked about the method, Dr. Agbato. So the IVSC listed out all the valuation methods. So anybody doing valuation in America, in Rwanda, in Ghana, in Napoli, in Italy, or anywhere, or in Milan, provided that you have followed this standard now, then it underpins what? Consistency, transparency, and confidence in the valuation. That is the essence of it. Let me also announce to you that the Nigerian Institution of Estates, Surveyors and Valuers, NIVES, is also one of the registered members with the International Valuation Standard Committee. So whatever we are saying now, NIVES and ESVABON, those two institutions that govern the practice of valuation in Nigeria, are also key members. They are key members of the International Valuation Standard Committee. So whatever we are having is also something that is acceptable to Nigeria and to Nigerians as a whole. Now, let us look at some of the changes in the International Valuation Standard 2022 so that we can note them. Now, effective dates. As I said earlier, the standard became effective on the 31st of January 2022. What that means is that, let us take note of what I'm going to say next. Any valuation that you are going to do rising from this program needs to follow International Valuation Standard 2022. So at the addendum page, or maybe the last page of your evaluation, I've completed this valuation exercise for Zenith Bank. I haven't complied with International Valuation Standard year 2022. Please take note. So all previous editions, 2020, 2017, they are all valid. But the current valuation standard is the one that we have for year 2022 that became effective. Another thing, in the International Valuation Standard 2022, a new chapter was also created. Now, what this means is that in the previous valuation standard, there was nothing called IVS 230 valuation of inventory. Please take note, valuation of inventory is a new chapter that has just been created in the International Valuation Standard. So the essence is that 2020 IVS is good, but 2022 has improved on year 2020 IVS. Year 2022. Can you move on to the next slide? Some of the changes. The next slide, please. Some of the changes made into the IVS 2022. Yes, beautiful. So I spoke about the effective dates. Now we are talking about the new chapter. In IVS 2020, there's nothing like valuation of inventory, but now you have it now, which is under IVS 230, inventory valuation. We're going to talk much later about the valuation of inventory and what it is and give you practical examples. Now, technical review. They said updates, and the person speaking, please mute his microphone, please. Now, technical revisions. Updates also included the technical revisions consulted on. What this simply means is that I've mentioned this aspect earlier. 2022 edition is an improvement on the year 2020 edition. So they consulted wider before coming to a conclusion and adopting IVS 2022. Now, another aspect, we are talking about some of the new things that you would see that were not in the previous edition, justifying why we need to comply with the valuation standard. It says the IVS glossary has been updated to include new terms and provide additional clarifications. The changes also reflect the International Valuation Standards Committee's ongoing effort to align valuation terminologies and definition. If you've listened carefully to all ESV David Marcelli has spoken about, all these terminologies and definitions were well broken down by him, thanks to this IVS. So the essence of why we are even talking about the IVS? Why not just stop at the valuation method? There are certain changes and definitions. For instance, ESV David Marcelli spoke about the fair value and gave an example of what happened between two surveyors, the junior one and the senior one, where they were arguing that what is fair value? What is the open market value? If you study this new IVS, clear distinctions were made with examples of what constitutes a fair value. Yes, but I also mentioned it. If Guinness, for instance, has called you, or Nigerian Breweries has called any value and say, come and do a valuation for me. This valuation is for our shareholders in our reporting, annual reporting that we are going to present to the shareholders during the meeting. And we want you to report based on financial reporting purpose. Definitely in your valuation, consistency with what has been stated in the IVS is that use fair market value because it is for what? Financial reporting. Guinness is not taking that report, or Nigerian Breweries is not taking that valuation to bank. So don't let us assume that all valuations are for secured lending. No, not all valuations are for secured lending. So all those annual reports that we see where they say, oh, dividend is 2 naira per share, at the end of the year, you attend some AGM, annual general meetings of organizations, and you see property, plant, and equipment inside their prospectus or inside their, what's it called now? Like the brochure that they have presented. That has value. Where you see the property, plant, and equipment value, it is basically fair value that has been reported, which is not consistent with the definition of open market value. Open market value, as Agbato said now, is a basis of valuation that they want to dispose this. The bank wants to use this property as a collateral to give you mortgage facility. You are reporting to Zenith Bank or to Guarantee Trust Bank open market value or market value with a view of using the property as a collateral. Fair value is not the same. So IVS is telling us, if you study the IVS, they distinctively defined fair value and also market value. So those are some of the essence that we must learn. Then the next one says IVS framework. The section of the IVF framework talks about compliance with standard, assets and liabilities, valuers' competence. Yes, I better closed with that carefully. If you know you cannot do it, there is no shame in inviting senior colleagues who can handle the valuation. And also there is no shame in inviting people who are technical. Like for instance, now if you are reporting for financial reporting, you are doing evaluation for financial reporting, you can work with accountants. You are doing valuation for engineering assets, aircrafts, or maybe power plants. You can work with engineers, but that doesn't mean the engineer is going to kick you out. But competency means ability to deliver on the job. Let's go to the next slide. There's other into let's go to the next slide, please. Now, the arrangement, let's talk about the arrangements in the International Valuation Standard. For ease, what I'm doing now is for anyone who wants to go and study the standard, I'm breaking it down for you to understand. There are 3 aspects in the International Valuation Standard. There are 3 aspects. And the first aspect is IVS framework, 1. The second is the general standard. And the third aspect is asset standards. So in the IVS, if you are reading the IVS after this program now, there are 3 things that you would observe. The first part is the IVS framework, IVS general standard, and IVS asset standard. Let's go over to identify them one after the other. The next slide, please. the IVS, the arrangement of the IVS. Go to the next slide. Next slide after this one. I have about 12 more minutes. I'm going to rush. Yes. So the IVF frameworks now, I said this series is a preamble of the IVS. The IVS framework consists of general principles for valuers following the IVS. Valuers need to be objective. Objectivity, don't, oh, I'm not sure. Oh, no, please be sure. And say it in affirmativeness that, okay, well, I am of the opinion, I haven't done this, I've done that. It also talks about the judgment. When we define valuation as arts and science, the art aspect of the valuation is that a valuer is allowed to use his judgment. That is why it is called opinion of value. It is not entirely scientific. So that's why the word judgment, even judges, that sit down and decide over a case, they study, they look at things and look at all those. So the valuer is allowed to use his judgment. You have to be objective and also use your judgment, and you must be competent. The next one talks about the general standard. The general standard is where you have the basis of valuation, valuation approaches, method of valuation, how to report. Then the last aspect talks about asset standards. Let's go over to the next slide. Now, this next slide now talks about the IVS framework. I've defined all these ones. So let's now look at the IVS general standard. IVS 101 talks about the scope of work. ESV Agbato has talked about it, and also ESV Marcelli. If you are doing a valuation, I said it earlier, don't assume that you are valuing all the assets. An organization, for instance, can call you and say, well, for this valuation purpose, you are only doing our land and building. Yes, we have so much assets. We have generator, we have cars, we have all other assets scattered across the federation. But understand the scope of valuation. Ask them that, what are we covering? Don't just go, okay, the excitement, we have been given an instruction, I'm going to do a valuation. I'm going in there now. Please sit down with the beneficiary and understand what scope, what are the things you are going to cover. Then IVS 102 talks about investigation and compliance. A proper investigation of the area. I talked about it the other time, that go to the sites, inspect the property. Inspection must be done 100%. Don't assume as, okay, we also have some vehicles in Kaduna, but because of the aviation fuel issue and crisis in the aviation industry now, you may not be able to travel, you may not be able to inspect it. No, the valuation standard is simply telling us that you should investigate and make sure you comply with the standard. IVS 103 is talking about reporting. The reporting aspect talks about what are the things that will be in your report, the date of valuation, date of inspection, description, measurements, and all other things. IVS 104, basis of valuation, ESV, David Marcelli has dealt very well on that. Also, IVS 105, valuation approaches, have been spoken about very well by ESV Agbato. So now let's look at the asset standard. Please go to the next, IVS asset standard. Now, I mentioned earlier that IVS 230 was introduced afresh. So I'll quickly do some brief discussion. IVS 200 talks about businesses and valuation of business and business interests. I'll give an example. Dangote Industries as a whole that belongs to Alhaji Aliko Dangote can be described as a business. No. Let's take one aspect of it now. For instance, Dangote Cement now is a business. Dangote Cement is a business. If you are doing a valuation of that business, which is also quoted in the Nigerian Stock Exchange, what you need to comply with, how the valuation will be done, you have to follow what? IVS 200. I'm going to repeat what I'm saying. If you are valuing a business interest, I'm quoting it now, there's a difference between a business interest and an individual asset. I'll give you an example. Zenith Bank or Access Bank has called you to value a property in Ikoyi, one property. That is not a business or business interest valuation. Let us be clear. That is an individual asset that is being used for either for purchase financing. I'm using Dangote as an example, or Sun Motor, for instance, as an example. That is a business. And then Sun is looking at expanding, is looking at getting finances. As we are all aware, which is not something that is hidden, the refinery Dangote is building now is probably being financed, not by his own capital. No, go back. We are not yet on litigation. Go back to the asset standard. Go back to the asset standard, please. I'll soon round up in the next 10 minutes. Portal, please go back to the asset standard. Okay, yes. So that's the litigation is the last aspect. We have 2 more slides. So I'm giving an example of what constitutes valuation of business and businesses and business. So an individual asset does not come under valuation of business. Dangote Cement now can be considered as a business. So which means you have to work with the accountant. You are going to value the physical assets as well as the intangible assets of Dangote Cement as a business. So if you are valuing their land and building, the cars and all other things now, it is not valuation of business. Then in accordance to the IVS, he said you can use 2 methods of valuation for valuing a business, income and comparison. But cost is not always recommended because of the intangible aspect. Now, the next one, if you are doing a valuation in the year 2022 now of intangible assets, what constitutes intangible assets are those assets that are not physical. For instance, data. We are talking about goodwill. You can value the assets. I'll give you an example. Twitter is coming to Nigeria. Twitter was suspended. The Nigerian government, when they suspended Twitter, they didn't suspend maybe one building or suspend an organization from operating. Twitter is operating online, in which we go there, we express ourselves, we share things, we share news. So the aspect, Twitter aspect, for instance, now they deal with data and some other information, something we post and get shared and get seen. So for asset, a good example of assets like that are things that we cannot see. Goodwill, what's it called now? Intellectual properties. Those are the things that constitute intangible assets. So if you are doing any valuation other than land and building that constitutes intangible assets, please refer to IVS 210. For intangible asset valuation, read IVS 210. Now, IVS 220 talks about non-financial liabilities. Non-financial liabilities constitute liabilities on organization. I'm going to give you a very sweet example that will make us understand it easily. Now, DSTV, for instance, we all know what is happening in the power sector in Nigeria now, that there's really no electricity almost everywhere. The national grid is collapsing, collapsed on Monday, collapsed on Tuesday. So those of us that have paid our subscription, DSTV, I'm using DSTV as an example to talk about non-financial liabilities valuation. DSTV as an example, for instance, you have paid your annual subscription to DSTV for 1 year. And because of electricity, you're unable to watch the Champions League match, Man United versus Atletico Madrid, that was, played yesterday. You are unable to watch the match, for instance. And then DSTV has looked at it that, okay, electricity is happening, electricity challenge is happening in Nigeria. There's also fuel scarcities in some parts of Nigeria. How do we compensate those people who have already paid us for 1 year, but they are unable to view? For instance, now, DSTV can compensate you in form of liability by not refunding your subscription. But DSTV in turn will do what? Would compensate you by giving you more extra days. I'm going to rephrase now. So what constitutes non-financial liabilities? These are liabilities on organization, but that the organization does not really need to refund you money. Another example is vehicles. Let us look at Sun Motor, for instance. They manufacture, they apply, they assemble vehicles in Nigeria. After you bought a vehicle from Innoson, let's say 7 million naira, you drove the vehicle from Anambra State down to Lagos, and in the process, you are hearing some sound that the brake pads are probably bad. Now, to Sun Motor, at the end of the year, when they are reporting about their valuation during their financial reporting, they have to note that fact that, okay, this is a liability on us. Although Mr. Kelvin has bought this brand new vehicle from us, and then there is a need for a recall or warranty, we are going to replace this vehicle for Mr. Kelvin without necessarily giving him money. So that is what constitutes valuation for non-financial liabilities. Loyalty. For instance, many of us would notice that Coca-Cola, for some of their, marketers, they do give them branded fridge and all those things. Those constitute non-financial. They are liabilities to the organization, but the organization does not need to commit money. I'll give you an example. If you are paying salaries now, that's a financial liability. So in your books, if you are doing the, audited financial reporting of an organization, when you pay salary, those are financial liabilities. But liabilities that are not financial on organization, on DSTV, on Sun Motor, or any other organization constitute those non-financial liabilities that are reward program. Let me go to IVS 230, inventory. Inventory constitutes what we can describe as what goods and services that are going to be used for the production of the item that the company deals in. I will use the example for Dangote, for instance. We know cement is made from limestone. So Dangote before bagging, before the cement, a bag of cement now, 50 kg bag of cement selling for between about 4,000, 4,500 naira. So for valuation of inventory for a Dangote cement, for instance, if a valuer has been called to come and value inventory, we are going to be valuing the stock of that organization. I'll make it clear now. We are going to organize an organization to value their inventory. Inventory does not really constitute land and building. It constitutes the stock of that organization. A Dangote cement that sells cement, for instance, in their warehouse, they might have 3 million bags of cement that have already been produced. Dangote is looking for finance or looking for loan from any of the bank and say, well, we don't have land and building. The Obajano factory, we actually leased it out. It doesn't belong to us. So what you can collateralize for Dangote is the inventory, which is the stock. So if you study IVS 230 very well, it talks about valuation. So if you are doing any valuation of inventory, like the raw materials that are going to be used, for instance, a bakery that buys flowers in bulk, the inventory of that bakery are those flowers that are already stored. So if you are doing a valuation for a bakery that needs money to do some other things now, what you are doing, the inventory of the items that the organization have that they are going to use to produce finished goods, they are going to use it to produce goods. So that constitutes valuation of inventory. Then IVS 300 talks about the plant and equipment. ESG has dealt with that. Then IVS 400 talks about valuation of real property interest, our regular land and building. IVS 410 talk about development property. Many of the students who are with us now would recall there is a particular method of valuation we are taught then. That's the revaluation method. What we call this revaluation method or development method of valuation, in which residual method of valuation. So this aspect talks about that, trying to determine the value of the land. There is no building on it. So this aspect, IVS 410 talk about that. Then the last aspect, IVS 500, as contained in the national valuation, talk about financial instruments. What constitutes financial instruments? The stocks, the bonds, and all those things that we have, the shares. So for you, if you are valuing stock of an organization, shares of valuation, or treasury bill of the federal government of Nigeria, for instance, consult IVS 500 for that. And then the last slide now, which talks about litigation. As a part of justifying why we all need to rely on these valuations, and I'm going to share a story that we had in the year 20. Many of us.
Sorry, Demola, you have 5 minutes left.
I'm going to round up. Thank you very much, my chairman. So last aspect, now let me talk about litigation. I'm going to give you an example. There's an example that I shared here now on why valuers need to work with the valuation standard. An incident happened in the UK around 2008 to 2009. Many of us remember that there was a great economic recession in 2009 towards the twilight of President Bush administration in America. And then when Obama came in January 2009, a valuer did a valuation. And at that time, before the recession, he valued the property for about £1 million or so. And then the recession came in. Many of us would realize that around that time, about 12, 13 years ago, there was a crash in the property market. As a result of that crash, a lot of properties, became depressed. Then the bank gave a facility in year 2008 based on the valuer's reports.
Thank you.
But in year 2009,
well done.
In year 2009, during the recession, the property was this same property that was valued in 2008 was offered into the market, but they could not achieve the for sale value because the bank in the country gave a facility using the for sale value of the valuer. Now, after giving the facility, the bank now went, when the customer defaulted on the payment of the loan, the bank now said, okay, valuer, you have told us that this property was worth £10 million. And now we are struggling to sell this same property for £1 million. What did you do wrong? The valuer gave an explanation, but the beneficiaries of the report were not convinced. At the end of the day, the matter was referred to the tribunal. So at the tribunal, the valuer gave his own presentation, and then the judge, they were looking at it that, okay, it's true, economic recession is not actually anybody's fault. It could happen in which you can do a valuation today, and then in another 3 or 4 years, your value is no longer valid. So you cannot entirely blame the valuer. However, there was a reason why the valuer was reprimanded, because the valuer did not follow either of the known international valuation standard. He was practicing in England. He should have used the RICS global standard. He did not use the Red Book. Neither did he use the international valuation standard. Hence, the valuer was held liable. the valuer would have been acquitted and then discharged that, okay, it's because of the market, there was economic recession, that's why we could not achieve the value. But because the valuer relied on a faulty standard. So in conclusion, for every one of us, we can see that while there is a need for us to get what we are learning in school, in the academics, in the line, knowing about valuation, there is also a need for us to fully study and understand the international valuation standard. I was privileged to review a report a couple of months ago, done by one of the top firms in Nigeria. And we are trying to, we saw some things, there are value differences in what we got and what they got when they did the valuation a year before we did the valuation. And at the end of the day, I was now studying the valuation. And a part, the valuer said, the valuation, the valuation was done in year 2021. And the valuer said he used the International Valuation Standard 2011 for a 2021 valuation. Automatically, before the people that were defending the report, irrespective of whatever happens, the valuer's report was rejected on the basis of valuation standard. The valuation was done in year 2021, and the valuer said he used a valuation standard of 2011 to do a valuation in 2021. So all these things matters. All these things matters. Valuation standard matters because of what the stakeholders is the beneficiary of your report. The only thing that will give them that confidence to say, well done, valuer, irrespective of the value you have given me, because you have followed the right standard, I believe in you, is for you to rely on the international valuation standard. So attending trainings like this, participating in forums that keeps teaching us and learning and relearning will only help us to move forward the valuation profession and also to earn the stakeholders' confidence in anything we do. Ladies and gentlemen, this is the end of the presentation, and we thank you very much for listening.
Thank you.
Good job, sir. Good job.
Thank you, Demola. We are happy for this presentation. And when we look back, they say when you are moving forward and you look back, you see people following you, you will be happy.
Yes, yes.
When you look back and see people like Demola coming up, you will be happy and will thank God for you. Noble colleagues, my president, noble colleagues, while we are listening to the presentations, our first vice and second vice joined us. There was a small mix-up. I apologize for that because I didn't give them the correct link. But if the first vice is on and the second vice, we would like to hear from two of them briefly. If they have questions, they can take their own question now, while we will not take question and answer section. When we get to question and answer session, if you have question to ask or comment, you raise your hand. When we call your name, you can now take your, but before we do that, you can listen to, is our first vice on now?
Noble colleagues, good afternoon. I hope you are hearing me.
Yeah, go ahead. My first vice, we can hear you.
Yes, sorry. Yes, please. The president on.
Yeah, the president has spoken. I don't know if the president is on, but the president has given speech.
My president, the second vice president, all other members here present. I just joined when I had Demola discussing or presenting his papers. I want to appreciate the faculty, the professional group, for the work they are doing, for giving us the opportunity to get acquainted with the latest terminologies and things coming from the IBS. I know that very good job, and this presentation is what they are presented, because I did actually join early because I was finding it difficult. What Demola said, I think going forward, some of these things will need to also be further broken down to most of our members so that they will be able to apply the current terms of the IVS. So on that note, I want to say thank you for this program, and I wish you all very well. Thank you, my chairman.
You're welcome, our first vice. Thank you for your time for joining us. Is our second vice on now?
Yeah, thanks very much, noble colleagues. My president, the first vice president, other members of the institution. I want to actually show my delight in actually joining this discourse. I'm sorry that I did not join early. I've missed some beautiful presentations, Dr. Agbato and co, but I'm sure we will have the soft copy of the presentation. But yes, Ademola did extremely well. I must commend the depth of his presentation, especially hammering on the need for us to valuation standards in delivering valuation assignment. Also, in ensuring that we make use of the current edition. And that means we need to update ourselves and ensure that we deliver. I think the best thing to, I've always said it, the best thing to fight quackery is to up our game, is to deliver quality service. And when we do that, I think we will have a lot to be happy about. I want to commend the faculty, the dynamism of this faculty in regularly coming up with creative and very, very, the professional group, P&E, for coming up with creative and very, very, relevant seminar topics. I want to commend you and also hope that, we will all have actually learned a lot. And please don't stop. We are really, really enjoying you, and you are doing a great service. On behalf of myself, I think I want to appreciate you and wish you more grease to your elbow. It's a lot of service, and I pray that all of us that are doing it will be rewarded accordingly, and our profession and our institution will continue to grow from strength to strength. Thank you very much. And I thank all the presenters. God bless you. Thank you.
You're welcome. Thank you, my who have in our press. God knows if you don't go close to them or have a peep into what they are doing and the time they are giving to the profession, you might take the activity for granted. We thank them for what they are doing for the profession and thank God for their life, because we need them. Anytime we knock, you call them all times, wrong time, they will answer you because of our profession. Thank you, our second vice. We will now take questions, comments from. I have ESV Gambo raising his hand before. I don't know if he has dropped. If he has dropped, maybe we should take Mr. Nuga, who is raising his hand for. Is there a question or comment? Mr. Nuga.
Okay. Thank you very much, Mr. Chairman. Greetings, Mr. President, the first vice president, and the second vice president. Mine is more of just a comment. Also, well, first, I must commend and appreciate the three presenters, ESV Samson Agbato, ESV David Marcelli, and ESV Ademola Ladega. What I want to just comment about is on the standards. The standards. Yes, the standards are changing over time. because we once had IVS 2017, we had IVS 2020. Now we are on IVS 2022. The trend is changing, of course, new development. But from our registration board aspect, that's from SVABON. Presently, SVABON controlling the practice of the profession throughout the Federation of Nigeria. And what they handed over to registered ESVs as at today is still is the green book, and which encompasses the RICS standard and IVS 2017. That green book, the date on it is 2019. So I think the board should also, give an update on the standards to use, and to also, by means of doing that, that compels practitioners to also employ the current standards. Because as of today, if we go by the green book, we are talking about IVS 2017, and this is 2022. We have IVS 2022. So I think there should be an update from the boards as a view on that. That's my submission, sir. Thank you very much.
Thank you, Mr. Nuga. If you want to talk, maybe you give us a small, introduce yourself briefly and spend like 2 minutes for what you just said. I don't know, Mr. Nuga, if you're a state surveyor. The board is working on that. There's a program they did earlier in the year where they presented these standards. But it comes from IVS. When it changes, gradually we'll change our own too, and we'll adopt it. I can assure you that the board is working on it. Okay, we can take Dr. Gambo now.
Yeah, good evening, and I want to commend the presenters, the three presenters. They did justice to the topic, and we've keenly followed the presentation. I actually want to associate myself with the first observer, the first comment. I am ESB Dr. Yusuf Luka Gambo. I teach in University of Jos, and I'm interested in valuation standards. Most of my works are on valuation standards. The last presenter talked of international valuation standards, which are very, very good. But to me, mine is a comment. These standards, international valuation standards, they are minimum benchmark. They are minimum. We have, apart from international valuation standards, we have national standards, we have regional standards. Just like the blue book by Tegova, it's a regional standard. Now, a national standard, we have the red book, it's a national standard. We also have our own national standards, which the first observer, rightly observed that these standards came into existence in 2019. Was it 18 or 19? And since then, we have not reviewed our standards. The international valuation standard itself, they are minimum. Just like, let me give you an example. The international valuation standards, recognizes three basic approaches to value: the income, the cost, and comparative. But in Commonwealth countries, which Nigeria is one, we have other auxiliary methods, approaches, the profit and the residual. You see, there are peculiarities. That is why regional standards, national standards or regional standards, they come into play. The international valuation standard itself, they are just minimum benchmark for consistency, transparency, and uniformity. He gave good examples like Twitter. They want to take over an asset in Nigeria. They want to look at how consistent is your report. But we have our own local peculiarities, which are not reflected in some of our standards. So these international valuation standards, they are just minimum benchmark. That is my own observation. Thank you.
Thank you. Thank you, Dr. Gambo. If we understand is every day the discussion, it doesn't end. if you listen to presentations and listen to different presentations on fair value, on market value, the people are struggling all over the world to give us distinctions between two of them, for example. Different standards, trying to give us distinctions between two of them. But if you come to practice, now give one asset and said value it based on market value, value it based on fair value basis. I don't know the figures, where you get the data you use for the two of them. But anyway, there's still need for us to, education doesn't finish, it's a very dynamic thing. We'll see, do more talk on it to get our own definitions and how we can approach it from our own, because sometimes mentioning.
Mr. Chairman, there's a question from, what is the name again now?
It's on the chat.
Abraham, yeah.
Okay, I need all the papers. Okay, no. Is Abraham on?
He sent in a question. I think you can check your WhatsApp.
Okay, I'm trying to.
He's asking a question regarding this issue of market value, fair value, in line with international financial reporting standards.
I'm actually looking at the question now forwarded by ESG. They said, "Good afternoon, sir. Nice presentation, but I need to point out the following as per market value and fair value concept under financial reporting. The basis of value for financial reporting purpose under the International Financial Reporting Standard IFRS 13 is fair value." Yes, I got mentioned it. I also mentioned it as well. That's for financial report, because we said it clearly. That's why you need to.
Dewala, your voice is not clear.
The volume is very. Can you speak to the device you're using?
Can I respond to that question?
Okay, sure.
Let me. It's a very good question that Abraham has asked, because there's this position that fair value and market value is the same. But we have said that one of the things that international valuation recognizes is consistency in our report and the ability of the user of our report to understand what we are saying. So we have noted the fact that financial report is not meant for essay surveyor and valuers. It's meant for all the users, or board members, even the shareholders. So there must be consistency in our reporting. For purpose of financial reporting, fair value is the same thing with market value, but don't put market value as a basis of your valuation as a valuer. You must put fair value there. And the reason is this: accountant doesn't understand market value by their training. International accounting standard recognize fair value across board. So they don't understand market value. So we as a valuer should align ourselves with that standard. And let me say something because of this fair value issue. There's what they call a measurement and recognition of value by the accountant. What that presupposes the fact that they want to know the value they want to put at the first point of recognition. If, for example, the first financial year of a company, they want to input the figure for plant, property, and equipment there. The rules of engagement for financial standards says that the invoice from the company that they presented is the figure they should adopt. I don't know, maybe you understand what I'm saying here.
Sure.
So it's different that the evaluator will now say, let me go and do the valuation afresh by myself. No, the rule of engagement says that that invoice they've given to you is what the measurement for recognition at the first instance says. The issue is if the invoice they have given to me is more than what the actual value of the property is as a valuer, it's none of your business, because there's a proviso that subsequent valuation will require impairment testing. Is at that level they will know that, okay, there was over invoicing here and there. But the rule of engagement says that fair value is what shows that there will be consistency in our measurements, so that excess of your accountants, they are speaking the same language. So whoever is interpreting the report also will understand that is the language for financial reports. I think it's important for us to bear that at the back of our mind. It's the same thing in terms of definition. But when you are reporting financial reporting, don't say market value. Say you are reporting as what? Fair value. So that's just my own position.
Okay, thank you, Dr. Bato. You are saying the same thing in terms of, you say definition, is it, or in terms of approach to valuation? But in terms of reporting, when we talk of reporting,
okay.
Yeah.
There's a distinction between approach and reporting. In terms of reporting, in terms of if it's approach, there are different approaches.
Yeah.
Okay. In terms of reporting, that's what I'm trying to say.
Sure, you're correct. So I hope valuers, you can understand what we're saying. That when you come to financial reporting, if you're doing a evaluation for financial reporting, you have to use the language the other professionals that will use your report will understand. And the standard said use fair value for them. But if you are doing not for financial reporting, then you can go for your market value if you are looking for. So when we talk of this knowing standards, the idea is for us to know what to say at the right time, because the users will be able to understand what you're saying. But if you are doing the valuation itself, your approach for valuation is just for valuers to know the approach to use. That we don't need to bother, but though you still mention it in your report. Dr. Gambo, you want to make a comment on that?
Yeah, I want to add to this argument. You see, like he rightly said, as valuers we report market value, but for the purpose of financial reporting, our market value is their own fair value. One of the external forces that shape valuation practice and that really influence international valuation standard is the international financial reporting. So for harmonization, their own fair value is our market value, but you don't reflect fair value in your own report as a valuer. For financial reporting purposes, you report fair value. That's exactly what I want to say. Thank you.
Thank you.
Sorry, Dr. Gambo. Sorry, I don't understand your last the last sentence. That we don't report fair value as valuer. I don't think so.
Yeah. Thank you, VP2. I said, as a valuer, when you carry out your own normal valuation report or asset, for land and landed property, normal property valuation, what you report is market value. Because for financial reporting purposes, what you report is fair value. Because one of the forces that shape our practice, that informed the formation of the standard, evaluation standard, is international financial reporting. So to harmonize, there was a common ground that our own market value is their fair value. For financial reporting purposes, you report fair value, not market value.
Can I just make a comment here?
Sure.
Yeah. I think we are all saying the same thing, to be honest. I listened to Dr. Abato's explanation, which was fantastic. And Dr. Gambo, you are saying the same thing with what Dr. Abato said. But one thing I want us to understand is that the most important, you see, nomenclature, fair value or market value, they are nomenclatures. The most important thing to bear in mind is the basis of that valuation. The basis of valuing for financial reporting and for normal, market valuation is the same. It's the same. So that's why, the discourse in RICS, when this issue of financial report, fair market, fair value and the current market value came up, the discourse came to the conclusion that the basis is the same. It is the same practically, but like Dr. Abato said, when it is financial reporting, instead of saying it's market value, we report it as fair value.
Exactly.
You understand my point? So
yes.
The fair value, you see, if you are valuing a building, for instance, for a company, the value will be the same, reporting it in the financial report, it will be as the same as valuing it, for sale. Because the whole idea of international financial reporting standard was actually to stop this idea of straight line depreciation and consistent undervaluation of assets, which actually attracts, hostile corporate takeover and then results in asset stripping. You see, we all remember that what is this bank that bought UBA? What is it to the Limelus Bank that bought UBA? It was about Standard Trust, whatever the bank. Yes, that bank was probably about 20% or even less than 20% of the value of UBA. But because of the nature of financial reporting, the assets of UBA were consistently underreported. And it is not just in Nigeria. The same thing happened in England when Royal Bank of Scotland, which was about 20% of NatWest, bought NatWest. And the first thing they did, they didn't have that money, to be honest. But the business model was fantastic. So the moment they bought NatWest, the first thing they did was asset stripping. They sold a lot of the assets, especially land and buildings of NatWest, to recover their investment. And that was more than enough. So that was why the International Financial Reporting this thing came on board, so that assets of companies will be valued effectively at market value, but not reported as market value, but fair value. So my own contribution is the basis is the most important in whether we are doing fair value or market value. The basis is the same. And when you value for financial reporting, if you report a value, say 50 million for a building, for financial reporting, that in actual sense is the market value of it if it were to be sold on the market. So that is what I want to say. So both Dr. Agbato and Dr. Gambo were saying the same thing, but we just need to understand that the critical thing when we are talking about this market value and fair value is to understand that the basis is the same. And when basis is the same, then the resultant figure will definitely be the same. Thank you very much.
No, I agree with you. Thank you.
Yeah.
Okay. Thank you, my second vice, for that further clarification. And I hope members appreciate what we're saying. That, I mean, when you do your evaluation, both for fair value or for market value, you almost, as a valuer, are getting the same figure. But we're saying the difference is that if the evaluation is for financial reporting for the company, you have to use the word fair value so that the users, the accountants, will understand what we did. I think that's where the major difference is. We have Tajuddin Aminu. Please, can you unmute yourself and
Mr. Chairman, before we move out of that, this is David Marcelli.
Okay.
Okay.
Go ahead.
Okay, before we move out of the fair value and market value decision, when the financial reporting concept of fair value came, it came as a challenge to the valuation industry. And at the end, most of the practical notes and guidance from valuation institutions came to the conclusion that market value and fair value are technically the same. But over the years, current and accepted information and knowledge of fair value market says they are not the same. There is the same, if you check, there is the same methodology as seen in my table. You see the diocese comparison, the same method in arriving at it. But in practical sense, if you in the practical sense in the field and you are carrying out a market value valuation, it's the same thing you will do, same procedures and everything. and you technically or more else arrive at the same value for fair and market value. But there are some peculiar situations in computation for fair and market value where you take into consideration things that might alter and you have the different figures. Like if there are some special attributes to the assets, which a limited market of you can deduce that a little segment of the market appreciates, but not the general market as confirming market value, then you bring it into place and affect the difference between your opinion of value for fair and market value. So it is generally said they are not the same in terms, but in terms of in practical terms, if you are computing it, you might always arrive at the same value. I feel I should state that, and we need to read more on that. Current knowledge, within the valuation industry on fair and market value, as at past where they recognize them as the same, currently it's not accepted as the same. But practically in the field, we arrive more or less on the same figure between market and fair value, because market value is limited. Market value is strictly guided by the demand and supply, but fair value has some leeway in terms of considering some special intrinsic nature of the property that to the property, which is beneficial to even both the owner and also some potential buyers. Thank you.
Thank you. Do you still have any other comment or question for the presenters? There was one, Uchechukwu, that was raising his hand. Uchechukwu, do you still have question or comment? Okay, fine. If we don't have further questions and comment, I think we'll be bringing this webinar series to close today. But before we do that, we would like to let our presenters know that it's just because it's okay. Tajuddin Aminu.
Good afternoon, senior noble colleagues. Standing on the existing protocol, I appreciate in person and particularly the audit sectors. They are spoken so well and they're so enlightening and educative. And my question goes to the management committee of the institution, ably represented by our president and his team. Please, what is this institution doing in collaboration with the NUC and MBTE to making sure that the curriculum that we used when I was in the school maybe over 20 years ago, it's not what is still being used now. With all this new innovation, improvements, standards coming up that all our presenters are talking about today. If the students are getting acquainted with all this improvement and innovation, I believe the next the graduates that will be produced in the next 5 years or thereabout will be more current, more sophisticated, and more current, knowledgeable and exposed than what we experienced when we were in the school back in those days. So my name is ESV Aminu Tagidi from Plateau State Branch, incoming branch secretary. Thank you very much.
My chair, can I quickly speak on that?
I could have asked if any member of the management committee want to make a comment on that first.
Okay. Yeah.
If not, we can now. Is our president on?
I think the first vice is there.
Let the first vice go ahead.
Yes, noble colleagues, I am very much aware that the issue raised by last colleague is being looked into. And even recently, I think SVAB will set up a committee and they are working on it. I'm very much aware of that. That they are already liaising with the AUC and other government agencies as regards not just only that curriculum issues, they're also looking at the O-level intakes. So work has been done about it. Thank you.
Thank you, our first vice. We have Darlington. Darlington, do you have a comment or question?
Good afternoon, everyone. That's the question I actually want to raise with regards to the curriculums, and this last speaker has actually talked about it. So I think this has sorted it.
Okay. Thank you, Darlington. What happens is that we know that something is being done about that with the NUC, but we must tell you it is very difficult to change things with Nigerian government and their bureaucracy. If you start a process with them, before you finish, I will assure you that the curriculum you are trying to change in international level, they have changed that one before you finish doing the one you started with the NUC. So it's a very difficult place we're operating. The only good luck we have is that most of our lecturers in the university teaching in School of Estate Management and Valuation are all members of our profession. So it's easier to get them participate in our programs, know what is happening on current curriculums, and they will not take it back and blend it to whatever NUC is giving them. But if it is the process of changing through NUC, I can assure you that before you finish one, we'll be late again for the next one at the international level. Thank you. In the absence of any other comment or question, may I sincerely thank our presenters, ESV, Samson Abato. Awal, you have a comment or question so that we can close, because our time is, okay, we have 5 minutes.
Good afternoon, everyone.
To shut down. Okay, Mohamed Awal.
The thing I want to ask about between the fair value and market value.
Your voice is breaking up. We can't hear you very well.
Fair value and market value. And I also noticed that the fair market value. So that is the differences between the three I want to.
Okay, I couldn't pick very well. I'm sorry, I couldn't hear you very well because it's like your internet is having some glitch. Yeah. Awal, are you there?
Yes, sir.
Okay, what did you ask?
I'm talking about fair value and market value.
Okay.
So you guys mentioned two. So I wanted to ask about fair market value.
No, we don't have fair market value. You have market value, you have fair value.
Sir.
Oh, thank you. Okay. Thank you, noble colleague. Thank you, the students that were able to join. Thank you, the lecturers that were able to join. We'll thank our president. We'll thank our first vice, second vice, council members that were able to join today's webinar. Because it's a virtual section, we have our thank you plaque we have for the presenters, which we will send to them. We have for Dr. Samson Abato, PhD. We have for ESV David Marcelli. We have for ESV Demola Ladriga. We thank them immensely for their time and for taking time to prepare whatever they have presented to us today. But it's not finishing. Anytime the group or the institution calls on you, please continue to oblige us. And we'll thank God for your individual and collectively. We'll thank God for everybody's life. Long live our institution. Long live Federal Republic of Nigeria. Thank you and good afternoon, noble colleagues, friends, and students that have joined us today. We'll come to a close and we'll let you know shortly when the next one is coming up. Olaruwaju, I'm sorry, we can't take any other comments because our time is well spent. Thank you very much, noble colleagues, and have a good day.
Thank you very much, Mr. Chairman. Well done for a successful program. Bye-bye.
Thank you so much, sir. Thank you. Bye.
Thank you.
Good morning, Mr. Thanks very well. Thank you. Well, enjoy.
Mama, we appreciate your effort. God bless you all.